Hello and welcome to another episode of Fintech Focus TV with me, Toby. Today, I am utterly delighted to be joined by David Williams from EY. David, how are you?
Yeah, hi there. Hi, Toby. Yeah, no, good, thanks. How are you?
Yeah, really good, thanks. Really good. Listen, lovely to speak to you. Been having a little preamble beforehand, and it sounds like things are going well. Tell us a little bit about your background and what you do to kick us off, and then we'll get into the detail of everything there afterwards.
Yeah, sure, Toby. And thanks for having me. Actually, it's very, very timely because I was trying to think of ways to get my children off YouTube, and actually having their rather uncool dad on YouTube, I think, is probably the biggest deterrent for them. So hopefully we've solved that problem.
They're going to love it. They're going to love it.
Indeed. They're going to cringe when they say this. No, so I'm banking and capital markets technology partner at EY. So we help clients to get their most complex and challenging transformation programs done, usually enabled by technology. So pleased to be here, and yeah, happy to have a chat.
And it's really interesting, isn't it, that space? Because you've seen that you've got a good spectrum, and we've spoken over over the years about some of the great innovation that's happening in banking tech, and I think that continues to sort of probably go at an even greater pace at the moment. And if we were saying beforehand, if you looked at it and sort of foreseen what was going to happen with COVID, you probably would have been a little bit more concerned about it. But what it's actually been is probably one of the great fires under the sort of bonfire of innovation that we've seen in the digital transformation space.
I mean, it's just amazing. We've seen months, quarters, or even years worth of innovation take place in a few weeks, just out of necessity, right? So that banks can continue to provide services to their customers. It's been phenomenal. Even just the internal collaboration aspects. I mean, we were lucky enough, I think, at EY to have implemented Teams about 3 or 4 months before lockdown. So we had all the sort of the video conferencing tech all lined up, and that's
by design or by
no. I think we got lucky on that one, but it was sort of very prescient. But yeah, so seeing the adoption of that around the workplace has enabled everyone, I think, to carry on working to a degree, and in most cases pretty successfully. I think it's a massive credit to the financial services industry as to how little disruption there has been, really. I mean, I think whilst there's been some inconvenience for end users in some places, it's been tremendous. Very, very little market dislocation. I think you look at the way markets performed even under the peak volumes immediately sort of under lockdown. Yeah, we did see a spike in settlement failures in some organizations. I think that what that showed you is COVID has probably just exposed some underinvestment in some of the sort of post-trade and back office technologies. But most banks got through it pretty well. We have some fascinating conversations around governance in particular, and how out of necessity banks have moved to making much quicker decisions, much less paperwork. Gone are the days where you turn up to an exco or a steerco with reams of PowerPoint. What's been happening is people have been turning up, using their judgment, and on the whole, I think making pretty good decisions as a result. I think that's probably been an eye opener for many organisations.
Yeah, I think that's really interesting, isn't it? Because efficiency is one of the things which we're definitely seeing from that, and we've spoken about the benefits of balance and working practices a lot on the show, and I know we've spoken about this before as well. The sort of perceived benefits of what we can come out of this from, but also that just true efficiency of some of the inefficiencies that were happening beforehand have suddenly been massively exposed, and people have been able to come out of it stronger. Do you think that will be a trend moving forward? Is everyone going to go back to it all, or is it?
No, so I think the trick now is how do you keep the good things that have come out of COVID, and then how do you fix the issues or the compromises that you made? So in many cases we've seen, I don't know, some control processes slim down in order to get stuff done. So then banks have got to work out, is that something we need? Have we actually just reduced a bunch of process and we're still managing the risk absolutely fine, or do we need to go back? And that's going to be a judgment call. What's been really interesting is in some of the offshore delivery centres. I don't know whether you've ever had the pleasure of visiting any of those sorts of places in cities like Bangalore, but many of those centres are set up to prevent data from leaving the building. So the controls in place around mobile phone usage and laptops coming into the building, etc. So they're designed to be highly secure. And of course, that's worked against some organisations in that they've had to allow people to work remotely to get stuff done. So they've had to make some compromises on the controls there. So it'll be interesting to see the judgment calls as to how many of them come back in. But I guess the other thing to look at is the shift in channels. So a lot of end users of finance have been forced to shift into digital channels, whether it's speaking to their travel insurer or whether it's dealing with their bank on a day-to-day basis. And a lot of the financial services firms are probably quite pleased they've got more take-up of digital channels and much more usage. The question now is how hard do you want to keep your customers there?
Yeah.
And of course that has some profound knock-on implications into things like branches. And of course that's a very thorny debate, as you know, because there's demographics around the country who will be absolutely distraught if branches close. But there's a profitability question for the banks. So it opens up that debate again as well, I think.
Well, I think that's probably been in line with the rise of the Monzos and Starlings recently. I mean, it is a generational piece as well, but digital banking has been a trend that wasn't going to go away for a while. And I think actually, because of this and because of generally who's been shielding and who's had to adopt digital skills at the same stage.
Actually, there's been some really great stuff done by the banks. I think they were very conscious that they had a pretty poor crisis in 2008. And wanted to, I think, do the right thing. And what we've seen is an amazing response, I think, from the banking community. I mean, some of the stories we've heard around banks using the data they've got about their customers to do some really intelligent and proactive things. So you can identify with a bit of data mining of your core banking platform. You can see pretty clearly who some of your key workers are, because you can see where their payrolls are coming in from. And that then allows you to go, okay, well, so if I know you're an NHS key worker and you're working pretty strange hours and you're under a lot of pressure, what proactive offers can I make to you? You might not be able to get to your branch, but can I put a call into you? Is there anything we can do to help you with? And I think that sort of intelligent use of data that the banks have got has been, firstly, very good for a societal cause. But secondly, I think it's opened their eyes thinking, hold on, we should be doing more of this anyway. Why aren't we being more proactive with offers or improving our service or spotting trends, etc.? So I think we'll see a big shift in the next 1 to 2 years to much more intelligent sort of use of data by the banks.
Well, data's been the sort of thing particularly across both retail and capital market sectors for a long time, which has been a buzz, but a buzz that not many have got particularly right. And I've always, I've said this a few times on the show in recent episodes that e-commerce and retail seems to be streets ahead of the financial markets in its use of intelligent data and business intelligence. And it's this I think will be again one of those things that it really promotes the user experience and the user journey. And I know you've judged on a few of our issues of the Financial Technologist, looking at some of the most influential companies, and overwhelmingly it's businesses there who get that sort of user experience right. And play from solving a user problem, and this has been another one of the great.
Another great. You mentioned e-commerce there, so another very simple but very powerful innovation that we saw during COVID was that rise in the contactless limit from £30 to £45. So what the industry did there was they looked at usage patterns. I think the average credit card transaction is, I think from memory, something like £36. The average contactless payment's about £9-10. What they did is they looked at supermarkets in particular and thought, looked at the sort of the profile of card transactions, thought actually by moving from 30 to 45, right, you're in that hump, right? So by a relatively small financial increase in the limit captures disproportionately more transactions and allows many more people to use contactless, and therefore less fingers on chip and pin machines and less spread of virus as a result. I mean that has almost certainly saved a load of lives, that simple decision. And that's I'm not saying it was completely trivial for all the sort of merchants to apply that overnight, but it was a fantastic idea to do that, I think.
It's very interesting, and we sort of touched on this briefly in prior episodes as well. But the sort of movement of the banking sector from the villains to some of the good guys across this has been brilliant to see as well, because it was such a vilified industry in 2008 for obvious reasons. that actually to see fintech for good, banking for for good in this sort of time span has been a real feature, I think, of the last
I think they've done an awful lot, and I expect to see an awful lot more. Actually, I think there's tons of stuff going on, which I think will change the game. You look at compassionate collections and sort of the breathing space initiative. So obviously, lots and lots of companies and individuals really hard hit financially during this current COVID crisis, and banks just putting in place measures to sympathetically work out what is the right treatment for that customer or that business in terms of any sort of forbearance on borrowing, mortgage payments, etc. So I think we'll see a lot more good to come out of that, because I know the banks are working really hard on that.
Yeah, definitely, and using as you say, tech to to do that as well.
Yeah, cool.
So that sort of moves us into the looking at the future. There is a sort of perfect storm at the moment of economic uncertainty. We've got we're coming to Christmas, some of the busiest times of the year for the economy, and everyone's locked down. We've seen a US election which looks more, we're still a day after it, still not really knowing where it's where it's going, and the uncertainty that brings. Brexit almost seems to have gone completely out of it, but we lurched further and further towards a no deal. Yet despite all of that, it doesn't seem quite as bad as it could be economically, does it? What's your views?
I think it's dangerous to make too many predictions. I mean, we don't really know where we are in this COVID crisis. How close to the bottom are we in terms of economic impact? It's hard to tell. One of the measures that the Monetary Policy Committee are looking at, the Bank of England, is negative interest rates. And the idea being is that would just again further increase of stimulus into the economy, but it's a pretty controversial decision. Now, we've obviously seen it in Japan, we've seen it in Switzerland, and some of the Nordic countries as well. So it's a pretty big trigger to pull. And clearly it has massive impact on savers, impact on borrowers, impact on the banks themselves in terms of the margins between saving and lending, and also whether they need to change products to be more fee-based products rather than rate-based products. So lots and lots of complexity there. We're here predominantly to talk about tech, though, and there's some pretty profound tech issues as well. So the Bank of England, the PRA, in their Dear CEO letter a couple of weeks ago, wrote to the banks. There's a voluntary response that's due in the next few days, and it was really interesting how much of that was geared towards the tech. Now you might think, why on earth is negative interest rates problematic for technologists within banks? And there's sort of you
wrote a really interesting piece about this, so I'm fascinated to hear.
Thank you, Toby. Yeah, so there's three root causes behind that. So there's the obvious one, which is people never even envisaged that interest rates could be negative when they wrote many of these platforms. Secondly, if you think back to sort of mainframes and some of the tech that goes back into sort of the 80s and 90s, and believe it or not, there's still loads of that out there. Programmers
it's difficult to get rid of it, isn't it?
Difficult,
costly and difficult.
Yeah. Programmers had to be really frugal, right? Because back then, memory was expensive, storage was expensive, right? Everything was at a premium. You had to be very concise in how you programmed this technology, and it actually takes more resources to store a negative number than a positive one. So if a particular field didn't need to be negative, you wouldn't set it as being able to be negative, because it would just take up more space. And so as a result, a lot of these sort of old platforms, it's a fundamental sort of operation to go in and then change all of that. A lot of these programmers have retired, and we saw it way back back in Y2K, having to get COBOL programmers out of retirement to come and sort of sift through the systems.
Great for the contracting market at that stage.
Yeah. So if you're recruiting sort of very senior programmers, then Toby, that could be a good market. But I think it's that's a problem. And then the third root cause is the laws of mathematics, and there are certain things you simply can't do to a negative number. So you couldn't take a square root of it. You can't sort of apply some of the logarithmic functions to them. And where that gets problematic is in some of the models. So some of the complex products or some of the valuation models, Black-Scholes, option pricing, whatever, you've got to go through and check them and just find some other way of calibrating that model if numbers go negative. Otherwise, you might get some strange outcomes. You might also get, if interest rates go to zero, right? You can't divide by zero. Yeah. You and I have both tried that on spreadsheets and scratched our heads and gone, what's gone wrong there, right? But it's it's just a fact of mathematics. So zero rates could also be problematic. The other interesting one was the Bank of England were looking at close to zero rates, and what they mean there is 0.00001, right? So effectively simulating, trying to get around the sort of the divide by zero issue, but by making it a very, now that becomes problematic because again you get sort of rounding errors, you lose some computational precision at that level in some systems. If you're thinking about data flowing all the way down front to back through a platform, all it takes is one system to only go to 4 or 5 decimal places and they round it, and you've lost the integrity of the whole sort of transaction front to back. And we saw a load of that in some of the MiFID II transaction reporting. So that's an issue too. So it's a really thorny issue, and it's going to impact systems, models, spreadsheets, interfaces. So where you've got interface controls to say, well, don't let a negative value, an unexpected value flow from system A to system B, because that might, we'd want to protect the integrity of system B. Actually, that's a perfectly legitimate value now. So you have to look at all of your interface controls to make sure they're fine. So we're trying to think through just how big an issue is it. And so firstly, we don't think it's the Y2K of banking in 2020. It's not that bad. If you look at Japan and Switzerland and other countries, the banking system hasn't collapsed because of negative rates, right? What we have seen is a load of workarounds, and there's a lot of hard work at short notice, but it was surmountable. I think what the banks are doing at the moment is they're coming up with, most well, I'd say probably half to 2/3 have probably done impact assessments. They're looking at, okay, how bad could it be? What's our range of response here? So is it do nothing and hope for the best? May not be that wise. Or is it do a full drains up, let's just go through and fix everything? That's pretty expensive and pretty time consuming at a time when you've got plenty of other uses for those development resources and etc. Or is it somewhere in between? So is it a risk-based approach? And then looking at how do you narrow down the risk-based approach? What are the things that would lead you to believe there may be a problem, may not be a problem? Well, so firstly, this whole legacy versus modern technology. So the modern platform is far less problematic on the whole. Secondly, vendor platforms versus in-house. Vendors have a duty of care to their client base. They're serving multiple clients. They're probably reasonably funded from an R&D perspective. They may well be operating internationally, in which case they've already sold it for other markets. So vendor platforms on the whole lower risk, but not risk-free. And then the third is it a domestic platform or an international platform? So I think the big worry is those UK platforms that only have ever served the UK market. No one will ever have looked at this before. So it's far more likely to be a problem. So banks are going to go through and they're going to have to come up with a sort of a pragmatic response to that. But it's very interesting the Bank of England has gone out, because obviously they want to feed the feedback into the Monetary Policy Committee. Because if the Monetary Policy Committee thinks, well, this is actually really problematic, do we need to find a way of giving more notice? Well, it's pretty unlikely, because rates are set once a month and they apply from a few weeks after. So the worry the banks have is this decision gets taken and they haven't got 6 months or 9 months, they've got 2 or 3 weeks. And then you're into workarounds. So how do you sort of deal with all the sort of impact on products at very short notice? There's going to be lots of kludges, I expect, but there we go.
Well, there's some interesting stuff you said there, particularly around look, we're used to, at the moment over the last few months of working hard at short notice and having to do workarounds. And if you look at how quickly the sort of lockdown happened and the scale of the pandemic over a relatively short basis, and how quickly people acted to that, the agility has been a feature of how people have responded already. So that's positive. And then the other side of it that was buzzing in my head there is a phrase which Professor Damien Hughes came up with, who wrote the Barcelona Way, funnily enough, Barcelona's culture. But he used a phrase which he said to me a few times, which is success leaves clues. And what we're talking about there is things which are problems, but problems that have been dealt with elsewhere, and that sort of ability have people like yourselves work with companies to help them navigate that ahead, just gives it a much stronger opportunity
for sure. So there's a reasonable amount, I think, to be learned from Switzerland in particular, and see how the Swiss banks coped. And the good news is the sky didn't fall in, right? So
well, we've seen that you mentioned Switzerland. I know you sort of pointed to the Nordics as well there. There's been Scandinavia. There's been some some real success stories coming from there about all sorts of financially it's always been strong out in Switzerland, but also just that politically and probably economically they've done things very differently to how certain companies have done. So I think that sort of what I think is encouraging about the virus is that at various different stages it's sweeping with different with different levels at different places. So there's always things that you can be picking up, and that I think also applies to what we're talking about here as well. So keeping on the future and some interesting stuff there, and I think I can really dive into the vendor piece where there's a lot of our client bases who sit there and we're seeing a hell of a lot more collaboration and vendors who are doing a lot more to work with the banks, and banks who are being a lot more open to procurement processes and introducing new technologies in various different areas that are proving it, which I think helps all of that. But I think there's loads of other trends that are coming for 2021 as we start to really look at that now, as November is incredibly upon us already. What's your sort of view of 2021 and what it holds in store for us?
I mean, I think it's going to be there is so much to get done in 2021 because you've got to look at the mandatory change agenda, so the stuff that banks have just got to deal with. So negative rates may or may not happen, right? But even so, there's some prep work to be done there. There's the whole IBOR transition piece, so the cessation of LIBOR at the end of 2021. That date doesn't look like it's moving, so there's a ton of work there for banks to look through all of their transactions with counterparties that go beyond that date, and they've got to work out what's the right course of action for each. Do you have to is there any full bank language you can use? Do you have to transition those contracts onto a new reference rate? That's a massive problem for sort of new product approval, reference data, new compounding models. It's a workflow problem, so you might have tens, if not hundreds of thousands of these to use, right? We've seen that from recent examples of sort of COVID testing, you can't do this stuff on spreadsheets at scale, right? So you've got to use sort of weapons grade workflow for some of this stuff. So that's going to be I think a big item on the banks list, and that's a global problem. That's not just a UK problem. And then you've got some of the other regs, seeing some delays in there, like CSDR, which is probably a good bit of breathing space at the moment. But then you get into the discretionary agenda, and that's where it gets really interesting, because you've got this sort of tension as well between sort of innovation and cost reduction. I think the two can go hand in hand, I think, pretty well. We've been looking at sort of, again, how technology plays out in 2021. Interestingly, we went back to a paper we wrote in 2016 around the fintech landscape in capital markets, and in that paper we sort of charted where we thought all the technologies would get to, whether they were just sort of redundant point solutions, sort of enterprise.
I've still got that upstairs.
Still got enterprise solutions, or even game changers. And we look back at that. You learn a lot from looking back and going, what do we get right and what do we get wrong out of that? And I think we call sort of AI, cloud, and RPA pretty accurately, actually. I think we were perhaps still slightly bullish on blockchain back then. That's still again lots and lots of interesting work going on. Still waiting to see the real game-changing benefits there in capital markets. So it's still on the watch list. Probably hasn't progressed quite as far as we thought. Smart contracts as well is definitely on the radar. But going back to, so where are we seeing the really interesting stuff? I mean, AI, I think, is probably the most tangible one. I mean, clearly cloud is a huge mandate for all the banks at the moment. Is that, how do you move to public cloud? How do you do it safely? How do you move at speed? How do you get the governance right around it? Yeah, and it's you look at some of the banks that had their risk in the cloud during the market spikes of COVID, were able to run their risk calculations many times quicker than others, which has got to have a huge commercial advantage. But it's a huge undertaking, and it is so complex. And most cloud transformation programs on the street are probably going a little bit slower than maybe the C-suite would like. But you've got to balance that speed and control, right? Because it's there's so much you could get wrong in a big lift and shift on cloud. AI, I think, is very, very tangible for people, because you can see examples where it's already working really well. So particularly, for example, in the cost avoidance around things like compliance, right? So some of the drivers of cost in compliance functions are false alerts. Right? So I was talking to one client who'd been rung up by his compliance function and said, look, you've just got to let you know, the CEO of one of the clients that you cover is on death row in Texas. And he was like, really? No, no. So we've got to investigate it. We just thought we'd let you know. He goes, who was that? And it was. They said it was a CEO of I won't name the company, but it was it was a household name, FTSE 100 company. Wow. He said that's really odd, because he's speaking at a conference in Copenhagen today. and what had happened was it was a name match had come out of one of the sort of fin crime monitoring systems, right? There had been no intelligent use of data to go, okay, what else could I know about this person? There was a negative news issue. Could I look and maybe other sort of KYC systems or other public domain sources, just to sort of try and triangulate that before I send an alert up? And of course, it was a name match. It wasn't even a date of birth match. It wasn't a nationality match, right? And this stuff just creates work. Right? So someone then in compliance or financial crime had to then go and create a file on this person, prove that he wasn't on death row in Texas, and then go, right, we've dealt with that, and write it all up, right? And you wonder why the compound annual growth rate in compliance functions is 14% a year in terms of cost, right? It's crazy. So simple use of AI, right, which is when you get an alert, right, simply go and look in the different stacks of data you have about stuff, right? Use a model, calibrate it, write a plain English explanation as to why that wasn't an issue, and then have some proper QA over it. So you keep a human in the loop to sort of monitor, but you can suppress the number of false alerts down, almost to nothing in most cases, and avoid work. So it's things like that we're seeing, which is just, I think are going to make a big game changer. We'd all like to do less work, right? So that's got to have a benefit. And we're seeing some intelligent sort of use of AI in some next best actions, right? With I don't know, relationship managers, for example. So just again, algorithms that are looking at transaction flows and going, hold on, did you know this client stopped doing X, Y, and Z? Is there a reason for that? Is there a pattern there?
So, I think it's really interesting, isn't it? That and it comes back down to that sort of experience factor. What's happening and how is it improving the the lives and the workflow and the ability to be productive of people. There's so many good tech. There's so much good tech out there that can really make a difference with it. I've also said that blockchain thing's fascinating for me, because I think it was 2016 you said the report, wasn't it?
Yeah.
I remember reading it. It's a good old brochure that you put together.
Yeah.
And reading through it, there's a lot of trends and a lot of predictions, and I haven't looked at it for a couple of years now. And to go back into
what's interesting, if you look at the pain points we called out back then, I mean, most of them are still unsolved, right?
Yeah.
The other problem we pointed out was the ways of working between banks and fintech firms, and the roles of innovation functions within banks, and how we were very sort of I know we've still got a strong opinion that having innovation in some sort of silo just doesn't work, right? Because you have an us and them culture between the folks at the coalface in the bank day in day out, and if you've got innovators sitting in a separate office, separate ways of thinking, and the two aren't joined up, you'll never. They're trying to find cool tech, and then trying to find a problem to solve with it, right? Which is the wrong way of thinking. You've got to start with a problem, and then find out what's the best possible way of addressing this using technology. And whether it is AI or it's some other tool, whether is it some sort of robot, or is it a case for a smart contract? That's got to be a decision that's linked to the problem you're trying to solve. not the fact you've got some cool tech you want to throw at stuff, I think.
Yeah, that's it's really interesting that, because it's it's definitely a sort of catchphrase of seeing people wanting to be cool and wanting to innovate, and as soon as you get into that position of just trying to force it, it's probably the wrong thing. And wherever we're seeing any businesses that are particularly on the ascent is identifying genuine pain points and then providing genuine solutions to it. And I think that sort of it's been a very interesting 4 or 5 years in terms of what's happened in that bank's relationship with fintech, because it was probably 5 to 10 years ago, it was fintech's coming to disrupt and destroy the banking sector, and then it suddenly became collaboration and adoption, and banks being very, very smart actually in how they did things. And look, when you talk about banking and innovation centers and such, like, I think Citi have probably got it as close to being the best up. The Barclays, I know, have done an awful lot of work around it as well, and they're probably, to me, Santander, HSBC, there are businesses there that have done some really aggressive work to adopt that and to try and incubate, and then to rather than to compete, which is what it was originally. How can we crush the fintech revolution? It became, how can we use it?
It's the pharmaceutical model, right? Which is the big drug companies will rather than have huge R&D budgets of their own, in many cases they're just looking to acquire. They see particular innovations out there, and they'll just acquire them. They'll look at them and go, okay, we'll have it. So I think with fintech, we've been saying this all along, right? It's effectively you're benefiting from external R&D that's been funded by private equity, venture capital, whatever, and then the banks can pick and choose the best ones, and then either sort of integrate them in a vendor-like model or acquire them. But you're right, it's collaboration rather than competition. I think is still the big trend. And I don't know. It'd be interesting to see what you've found, but I still see there's still some tension in sort of vendor risk management, infosec, procurement functions, because a lot of the banks, they're very well risk managed from that point of view. So in some cases excessively risk managed, but you can't apply the same tests and standards to a 50-person fintech in Shoreditch as you can a 300,000 person system integrator in Bangalore, right? You can't. You're not managing the same risk, right? Obviously, you're trying to manage against similar outcomes, but you've got to have a slightly more tailored approach to that. Otherwise, you will never ever get to work with the fintechs if you try and apply the same test to both.
Well, there's 2-3 different things I've seen on that in particular. I mean, the first one is, I think there has been the thawing over the last 6 months to allow speedier innovation, and the throttle on really good ideas has often been a procurement process that means it dies before it comes out. But I've been speaking to more and more startups at the moment who found different routes, different windows to break in through to allow it, and I think people have understood that the right sort of sponsorship have allowed it to be. I don't know if it's a little riskier. I don't know if that's the right sort of, the appetite to risk has increased slightly because of necessity, but it certainly seems that's been something which people have been more open, and it's become driven more innovation. Collaboration's the other side of it. People have been able to look at it and buddy up to get into places to speed up that evolution.
And the other challenge we hear from the fintechs is just navigating the very large banks are so complex to navigate in terms of stakeholder maps and routes through to someone to go, I'm going to sponsor it and I'm going to blue light it through a process. It's hugely difficult to navigate those organizations. We try and help a few of them do that where we think there's some sort of joint sort of collaboration case. So
and that's it. We've seen you guys doing that, and various of the larger vendors have done the same thing. I think Refinitiv have been pretty aggressive in that sort of space to allow people to sort of find a different way in as well, which has been good to see, right? I want to. I could speak about this sort of stuff all day with you, but I'm going to go on to finalise with with something which you're helping us with again, which is the judging of the Ultimate Fintech Workplace Awards, which you've been involved with in the past. So I think there's never been a more important time for companies to alongside innovate and do all the techie stuff and all of that sort of piece really well, it's also, never been a more difficult phase with such a diluted and diverse workforce.
Yeah.
To get that right, and I think I've been interviewing people now for the last couple of weeks, speaking to people all over the world actually about how they've been dealing with it, and it's been fascinating to see a huge diversity and some real thought and some real care and compassion that's been shown into it. So look, some of the things that we're going to be looking at from it, but from your perspective, and having been involved in a huge company that I know are very, very good at workplace and well-being and looking after people and the culture of the organisation, and I know it's been a big part of your role for a number of years as well. But tell us about what you think is a great workplace in the financial technology space at the moment, and what some of the things that you've seen that people are doing well, and what you'd be looking for when you're judging this, and to say this is what you want to see.
Yes, so in terms of the workplace, so I think you have to look at the values of the organisation, because that kind of defines who they are and how they operate. I'm looking for sort of inclusion, respect, integrity, all of those sorts of the features. Clearly, issues early this year have just brought out the inclusion part even louder. Some of the events earlier in this year, and there's been a massive focus I've seen from large organizations through to fintechs around and having that open debate, having a dialogue, and that's really important. We're having conversations now, pretty emotional conversations in some places, but they're conversations that were just not happening in the past, and that's really important. It's kind of a massive step along the way for progress. So yeah, I think it's we continue to look at our equality, proportionality of different subsets of our workforce, how they're doing in terms of progression, promotion, recognition, an increasing lens on that in terms of performance management, making sure that we've got no unconscious bias either in the recruitment process or the performance processes. So seeing those sorts of things, whether you're a big company or a small company, obviously different ways of doing it. Right, and there's probably some different proportionality, but just seeing that being recognised as hugely important. I mean, I've still heard some horror stories from some companies, not necessarily in the tech sector, even smaller companies, where you still hear some pretty bad behaviour going on. And you've got to think, this is 2020, right? And there's just no excuse for it. So I think it's that sort of that real health of culture is just massively important.
Yeah, no, absolutely, and I think we've seen. I know you're going to love some of the ones you're going to listen to in the interviews that we've done with these people around some real good thinking on that. And I think you guys have done some great work on that as well, haven't you? Because I know that bias in the recruitment process was something you guys looked at.
Actually, it's interesting.
A couple of years ago, in particular, wasn't
it? But even recently. So there's some roles we're recruiting for at the moment, and one of my female senior managers thought, I'm just going to run the job adverts through an algorithm that will tell us is it been worded in a way that's excessively male biased. So I think there's some plugin. I don't know which tooling it is actually, but there's a plugin. Effectively, you can run a document through it, and it picks out words that are associated with male or female bias. And then it gives you a score at the end, and it highlights the words and suggests alternatives as to what you could use instead. I mean, the encouraging thing was, what we drafted was actually pretty good to start with. But what was even better was we were able to fine tune it a bit better, because it is massively important to us that we attract and retain female talent in our organisation. But it's a great little innovation like that. That was, I know it's a free plugin that she used to do that, and it helped keep me honest, right, in terms of how I write these role descriptions.
It's fascinating, isn't it? There is so many little language tweaks that happen in that, and there's good tech that can help sort that out.
Even some of the words it pulled out, I didn't personally agree that it was a word that had male bias, right? But some psychologists and scientists somewhere have done the studies, right, and they've got the data, and they say that particular word is. So it's a learning lesson for us all, right? Because these are little sort of micro things that if now I know that word has male bias in it, maybe I'll use it a little bit less.
Yeah, so not one big thing, but 1,000 silver bullets. Talk about it, isn't it?
Yeah, for sure.
Well, look, I'm looking forward to hearing your feedback on that, and the work will be coming over to you shortly. So there's a good bit of viewing.
I look forward to it, Toby, as ever.
Get your popcorn ready, and you can enjoy it. Yeah. David, listen, it's been brilliant talking to you. Look, there's obviously real insight that you're providing at the moment, and I guess in times of change, you know, transformation and technology consulting comes to the fore even more so. There's real benefit you're adding to your client base, and if people are watching this and saying, look, I really want to dive into some of that insight that you brought beforehand, what's the best way of them getting in touch with you?
Probably through LinkedIn. It's probably the easiest way in the first instance, or probably go through that, and we can have another conversation. Yeah, for sure.
There you go. And if LinkedIn doesn't work, come to me and I'll see if we can reach out to you as well.
Yeah.
So David, it's been an absolute pleasure. Glad to see you doing so well, and thanks for all your insight on it. Valuable as always. And I look forward to speaking to you again very soon.
Absolute pleasure. All right. Cheers, Toby.
Great stuff. Thank you all for watching. We'll see you soon on another episode of Fintech Focus TV. Thanks a lot.